All right, we are live. My name is Amar, and I'm from Client First Capital, and this is my friend Kyle. And
Kyle with Clover Hill CPA.
and today we're going to be talking about some tax planning tips around retirement, maybe a top two or three, but really to kind of define what you could be doing and what you should be looking into as you get into retirement. A lot of people have on the top of the list, Kyle, is to move to a tax-friendly state. What should they be aware of when they're trying to do that?
Yeah, very big consideration, especially in retirement. The difference between living in California, for example, where a lot of your clients and my clients are located, versus living in a state with no income tax like Washington or Nevada or Texas or Florida, can make a really big difference. In your take home pay and your retirement distributions and all of your taxable income. So. Lots of considerations. It's state by state. There's different specific rules for each state in terms of what triggers residency, what triggers part year resident, what could crawl back some of your income into a specific state. So for California, for example, there's a somewhat of a bright line test of 180 days. So let's say you split time between Washington and California, for example, or if you're snowbirding, or if you have two states that you spend time in retirement, just being aware of the thresholds of what triggers the residency rules and what could crawl back some of your income to, a specific state that might not be as beneficial. So.
Yeah, absolutely. And oftentimes you should also think about what benefits you could be losing, right? And I find this a lot, in California. If you're above the age of 50, you can grandfather it in your property taxes. So if you're looking to downsize a house, you can move your cost basis into your new house, even though it's probably more expensive because of inflation and cost of real estate in California. You can always then have your old cost basis moved into the new property, and that's what you're basing your property taxes on. If you move out of California to go to a tax-friendly state, you've lost that benefit, right? So I've had clients that have moved out of California to later want to be closer to grandchildren and friends and family and decided to come back, right?
Regretted it, yeah.
And then you lose some of those benefits. So think 2 or 3 times about this decision. Another thing that I want to cover is a lot of times when you look at a portfolio holistically, you have this big pie, and different parts of those pies are more tax efficient in different places. So most people, you have your taxable account, you probably have a 401k or IRA, and then you have a Roth IRA, right? And so if you're getting interest from a bond, right, and you're getting a 1099 in your taxable account, but you could also hold that same bond in your IRA, and you're already going to pay ordinary income on distributions there. It may be better to have some of those buy and hold securities in your taxable account and keep those bonds or high transaction stuff in the IRA and Roth IRAs. I know from our firm's perspective, we try to do our best to do that, in the sense, keep the buy and hold stuff in the taxable account as best we can, keep all the transactional stuff in the 401ks, IRAs, and keep some of the things that are growth type investments in the Roth IRAs, being those are the last ones to touch. Maximize growth on a tax deferred and tax free basis, I think, is always beneficial. Any thoughts, Derek?
Yeah, I think you've touched on it, where you just want to review your kind of portfolio mix, because obviously different investments have different tax treatment, and identifying each asset and what that means for you in your retirement years, and where you're going to be and how that's taxed is all very important, and things that you and myself work through with our clients quite frequently. So
Yeah, for sure. Especially, the one that I guess gets under my skin. I don't know what the right word to use that's YouTube friendly. It would
grind
be
your gears.
Yeah. Is that sometimes we'll see clients that have the exact same portfolio, but in just different titlings, meaning like their IRA is a moderate portfolio, their taxable account's a moderate portfolio, and this exact same portfolio in both places. there is an ability to be more tax efficient. Why don't we end it with one more here, Kyle? What is, we'll call this the top 3 things to consider when you're going into retirement. So we got, really identify the state that you're living in or that you want to live in and the tax friendliness of it. And then we got reassessing your investment locations depending on, what's going to give you long-term capital gains versus, ordinary interests and tax that way. What would you say is the third?
I think just monitoring your MAGI, which is your modified adjusted gross income, is important.
Oh, yeah, that is for sure.
And just looking at which tax year you're going to trigger, an income event. And, it affects a lot of things like your Medicare premiums, your Social Security received, the taxability of it, your ability to continue to invest in your retirement accounts. Obviously the tax rate that you're going to get on pulling income out, whether it's capital gains or retirement income, and just monitoring that level year after year and making sure you're not disadvantaging yourself by taking something out in December when you could have waited till January and had less of a tax impact. So
I think this is a big one, and I think it goes understated. And I think it goes understated because most people itemize during their working years, and then at some point in retirement, they transition to standard deduction. I just think overall that's what most people think about. And then you're missing out on a huge opportunity to, I don't want to say systematically, but episodically take more income in certain years and then itemize and then get more deductions in those years, right? Because you can group some of your deductions together. And then in the other years, using the standard deduction or whatever and getting lower income.
Yeah.
And this is a good, big piece of, charitable planning can be part of this. I think there's other pieces that, we can talk through in terms of interest payments, et cetera, that could influence this in a big manner. Retirement is not like your income taxes and everything becomes easier and streamlined because you're consolidating, but that process of getting to that simplified tax return, it could be non-episodic, I guess is what I want to say, in the sense that like you should have several big years and then several small years, and that should kind of balance out as you rebalance, do Roth conversions, make charitable contributions. Those are all tied in together. So this has been a quick take of 3 things that we see in retirement and retirement planning from a tax perspective that can hopefully benefit you in terms of what you're thinking about in terms of planning. If you have any questions or comments, please leave it below. Please like and subscribe and all the other YouTube good stuff. We want to keep this a conversation. So if you have any ideas, please put it below. Any other closing thoughts, Kyle?
One more thing is I was going to say estate tax stuff.
Oh, yeah.
But we'll leave that for another topic for another time. But lots of considerations there. So it's a tough conversation to have is where do you want to die? But those are things that you should be considering
right
before your assets pass on to your heirs. So
yeah. And so maybe that'll be next week.
Sounds good to me. Yep.
All right,
All right.
Kyle.
Thanks,
Nice talking
Amar.
to you. I'll talk to you later. And
Bye-bye.
Thank you for joining us.
Bye-bye.